It's another shortened week for U.S. markets, another Monday shaved off by a holiday, and the markets again come back somewhat concerned about how many rate cuts this Fed is going to actually give them to keep levitating. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we're going to look ahead to the remainder of this week and see what economic data in particular over these next 24 hours is going to shape this narrative. It's a particularly dense day that should give us some echo for the rest of the week and where we are going. And as ever, the main question for the markets continues to be, what is the right amount of rate cuts? And this is not necessarily just for the U.S., though, of course, that is the most important story, the Fed being the driver of borrowing conditions and credit markets globally, not just in the U.S., but elsewhere as well, because, of course, other central banks in many ways take the Fed's cues, or at the very least are operating along parallel trajectories. And so the question again is, we spent November and December being very happy that many rate cuts are coming. Does that mean the global economy is going to fall off a cliff because we need that many? Or is the global economy not going to fall off a cliff, and then we don't need that many, and then the November and December everything rally across financial markets makes less sense? It is that second side of this coin that it seems has captured markets here at the beginning of the week. As we can see here, so far tracking for the week, standstill for stocks, looking like the S&P is a little bit soggy. NASDAQ basically flat so far on the week. But the rest of the macro asset landscape painting a picture that speaks to higher interest rates, fewer Fed rate cuts, and the attendant results as you might expect to see them. Crude oil down a bit. That speaks to a slower economy. Gold down a bit. That speaks to higher interest rates, which of course make an asset that yields nothing less attractive. The dollar is up a little bit. That of course also contributing to weaker gold. It is usually a kind of foil for anti-fiat speculation. And so when you have a situation here where, and of course, we're benchmarking the dollar against the euro here to give us a sense of its direction. So seeing the euro down 0.75% here essentially just tells us that the dollar is up. So the painting here seems to be kind of screaming out to see a unifying theme, which is higher yields, lower growth, lower anti-yield proxies, whether it be the dollar strengthening or gold weakening, or the 10 and the 2-year rates going up. The collective story appears the same. And the indecision there seems to be reflected in stock markets, because indeed, from stocks' perspective, if rates are higher because growth is going to be less bad, well, that's a good thing. If rates are higher and growth isn't going to be better, that's a bad thing. And what the thrust of this speculation means seems to be still lost on Wall Street. And so here's what we are beginning to see here. Of course, November and December were big months for building rate cut expectations. We can see here in the gray bars the spread between January and December Fed funds futures, telling us how much easing the markets are expecting for this year. And we can see that today, of course, things narrow a bit. So we had many more rate cuts in the end of last week than we do today, a bit of a pullback from extremes here. But in general, this seems to be starting to get a bit anchored. And with that, so are stocks. They are seemingly losing the ability to continue to rally on this rate cut story as it seems to find something of a steady state. At the same time, the US dollar's response is much more emphatic. And indeed, even as you get this spike in rate cut odds that comes out toward the end of last week, the dollar, nevertheless, on something of a march higher. Again, November and December are building rate cuts and a weaker dollar sort of narrative. And we very clearly come off that here, even though rate cuts are not necessarily going away in earnest, but at least have stopped getting very much deeper and seem to be kind of clinging to that 6 rate cut level, where we're looking for rates to come down 1.5%, which of course comports with 6 reductions at 0.25 percentage point each. And so with this in mind, we face a wave of economic data, a densely packed calendar to inform the various parts of this story, leaving the markets jumping from headline to headline and setting the stage for volatility. First, Chinese GDP data. And here we're looking for a little bit of a pickup in the fourth quarter from the third. The expectation is that year-on-year growth will rise from 4.9 to 5.3%. Now, that would not be a tremendous departure from the trend as it stands, and would essentially leave Chinese economic growth relatively anchored. In parallel, we are going to get updates on industrial production and retail sales data. Again, not controversial in terms of the expectations. A slight downtick in industrial production, a slight slowdown in retail sales, but numbers that generally register within recent ranges. Here's where this gets interesting. If we look at the way that Chinese economic data has recently performed relative to forecasts, this is data from Citigroup here, we see that it's starting to perhaps roll over here a little bit. So not only is the overall surprise index starting to drift a bit below zero, but the 20-day moving average, which captures the sort of monthly trend in this index, it seems to be starting to roll over as well. And that's something that suggests that perhaps we've gotten to a place where Chinese economic data realized outcomes are starting to fade relative to expectations, suggesting that perhaps China's economy is actually now looking weaker than economists' models are anticipating. If that's in fact something that gathers momentum here, then we could see some room for downside surprises on this incoming economic data, which of course, as we kind of weigh how many rate cuts is the right amount of rate cuts for what setting of global growth, influences very much that setting of global growth side of the story. China is the world's second largest economy. If its GDP, industrial production, and retail sales numbers fall short of expectations, that would certainly reinvigorate speculation that maybe there is a global recession here somewhere on the horizon. Not only is China itself the world's second largest economy, but the way it got there and the way it sits there is largely as a reflection of demand elsewhere. China famously is struggling after zero COVID reopening to really get back on its feet, because so much of its economic growth story is about being the middle node in a global supply chain where raw materials and semi-finished goods come to China. There's value add work there, so they become either finished or more finished, and then are shipped off either to be finished and then go to Western markets, in particular the US, where the consumer demand is, or just go straight there if they're finished already. But either way, China's role in the global economy is a kind of middle step between those economies producing the inputs for stuff and the places where the stuff is consumed, which is mainly the US and Western Europe. So to see weakness in China here would not only tell us a story about China itself, it would also tell us about weak demand elsewhere. And of course, with the US accounting for just over a quarter of, just over a fifth rather, of global growth now, and the Eurozone just under a fifth, we're talking about a window into demand across really the entire pie. And if that's disappointing, then the global recession story starts once again looking a lot more salient, which then, of course, seems to make an argument for more rate cuts, not fewer. It is a bit of a different story when we get to UK CPI data. And again, we're looking at a closely interconnected global economy. So though we are looking at indicators from China, from the UK, the sum total of economic news flow informs what is a global picture. And here we are looking at, perhaps, as we are seeing in the US, a reason to think that perhaps the amount of rate cuts on the menu should come down, not go up. Now, the expectation is we're going to inch down on headline CPI from 3.9 to 3.8%. If we look at how the breakdown contribution looks here, and this is, of course, November's numbers here, we still see that food remains the biggest contributor to inflation. And as with the Eurozone and the ECB, there's not a whole lot for a central bank to do about that. It's very difficult for a central bank, of course, to influence global food costs. And certainly there's not a level of interest rates that might be reached whereby you could discourage people from eating. So food is something of a throwaway on the upside. Energy is something of a throwaway on the downside. We can see here the main disinflationary or deflationary force here, deflationary by itself, disinflationary for the whole, is coming from fuel and energy. What's interesting, though, is that those areas where the Bank of England actually has agency, they seem to be very much discretionary spending and very much cyclical. Recreation is, after food and hospitality together with it, the main contributors on the upside. Now, when it comes to food inflation, as I say, there's not really much that the central bank can really do. And there seems to be something of a helpful trend already underway. Global food prices seem to lead into CPI with about a 7-month transmission mechanism. So if you lag CPI 7 months to global food prices, you get a sense that more weakness on this score is coming, regardless of what the central bank does. And there is some relief already in the pipeline, as it were. It's those cyclical ones, recreation and hospitality, where things are really interesting and sticky. And here, UK economy is showing some signs of life. Over the past 2 months, it's returned to growth. We can see the composite PMI index here, the blue line in the middle at 51.7, has returned back above that 50 line. This is, of course, in the logic of PMIs, the center line for determining growth versus contraction. Above 50 is growth, below 50 is contraction. And as you move further above 50, the growth accelerates. As you move further below 50, the contraction accelerates. So we can see here manufacturing still very much in contraction territory and has been there for quite a long time. Services, though, has seen something of a pickup in the past 2 months, and that's lifted the overall economy, and that line in the middle back above 50. And so there's been seemingly a little bit of a warming up here. Now, if that is going to translate into stickier inflation in these more cyclical components right here, well, then perhaps the Bank of England doesn't need to do as much easing as the markets have anticipated. And here too, as with the Fed, we are looking at a substantial global rate cut cycle. So if we consider then that both of these central banks, the US and the UK, on back-to-back days here, are getting a bit of a sense that the markets are scaling back how much easing they are expected to deliver, well, then perhaps we are in a situation where we are seeing a more generally restrictive, a more generally hawkish, of course in relative terms, perspective from global central banks writ large. If we consider the UK is expected to cut rates by about 1.3% this year. So call that 5 cuts. In the case of the US, it's about 6. But the story is very similar and the amount of easing very similar. So if you are getting a push away from that speculation, well, then you get a bit of an awkward juxtaposition if at the same time you are also getting a story about weaker growth from China. And by the way, the story in the US does get a bit of additional fodder this week as well. Rounding out the data that we're looking at over the coming day here, US retail sales numbers. They're expected to register with a gain of 0.4%. That's a bit of an increase from the 0.3% in November. And again, very much in line with the 6-month, 3-month, 12-month average. So not really a shocker, relatively middling, slow and steady, once again. And if we look at how U.S. economic data has performed relative to forecasts, analog to that index we just saw for China, it seems like here we were sort of clustering near the 0 line on the index, which suggests that essentially over the course of the recent months, from about August through to now, there's been this steady realignment of expectations with realized outcomes, whereby the economy and what people think of it are pretty well in tune. So we're not really surprising much on the upside. We're not surprising much on the downside. We're looking at a situation that seems to be saying that whatever the forecasts are for this retail sales data, we're probably going to register pretty close. Well, if that's the case, then we're going to get a middling outcome that doesn't really change the Fed policy calculus one way or another, which would comport with what really we've been seeing in the U.S. economy since August. helpfully here, you can see August is the spot where the U.S. economy seems to stop deteriorating. Now, it's not exactly improving. It's basically idling near standstill. Evidence the composite PMI number here, most recently in December at 50.9. We're barely clinging to positive growth, but we are clinging to it. It has held in this very narrow, slow and steady range since August. Hence, this same adjustment since August, suggesting that indeed growth expectations have increased a bit. And the reason, one might argue, they have is because the economy, while slow and sluggish, isn't any weaker. And so as we, or at least not weaker than it appears. And so what we are looking at then is data out of the UK and the US that seems to say, okay, maybe there are too many rate cuts that are being envisioned here globally, because maybe the business cycle is not roaring anywhere in these economies, but it's certainly not falling off a cliff to the tune of needing 5 to 6 rate cuts in a hurry, at least not yet. But the data out of China seemingly suggests that it's much too early to put any kind of recession risk to bed in earnest. And so when you curiously put all those things together, you end up with what is a fairly toxic mix for stocks, whereby you get higher rates and anemic growth, which of course doesn't bode well for cyclical assets. Perhaps you finally get something of a realignment of the Japanese yen and the US dollar on a risk-off side of the market, though more on that on tomorrow's show when we talk about Japanese CPI data coming up this week and why, against all odds, it could be one of the more important releases for a while. And you get a situation where the markets really refocus to the business cycle and which part of this dichotomy on monetary policy it seems to justify. But one way or another, the central confusion at the heart of equity markets remains. And the data that's on tap over the coming day tends to make that confusion worse, which may indeed start to weigh on stock market. And that is macro money for today. As ever, we are here right after overtime, Monday through Thursday. That's a show that I co-host with Chris Vecchio and Dylan Radigan, looking at what happened on Wall Street on a given day and what that might mean going forward. Back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the news and insights portion of tastylive.com. In fact, this very analysis is there in abridged form now. And opining sporadically on the platform formerly known as Twitter at Ilias Pivak. Thanks very much for joining, everyone. See you tomorrow.